GKFX Prime presents the Market Analysis Webinar.
Hello everybody, welcome to another edition of the weekly webinar. It was a huge week in markets last week, so in case you didn't see, a big surge in bond yields where US Treasuries, which obviously like everything else in financial markets, we always look first to what's happening in the US, and it was the US 10-year Treasury yield unnerved investors who sold out of some of the best performing assets of late. So that includes tech stocks, and really sent gold plummeting. Gold's now down at 8-month lows. A bit of a pullback in oil, but it still looks quite solid. Bitcoin came in for a pretty hefty week of selling, but slightly off the lows now. So we'll cover all of that and more. If you have any other markets you'd like us to cover in these webinars, please drop a comment in the video, and we'd be more than happy to cover them. Otherwise, just click that like button. That really does help us spread the word and keep doing these videos. Right, so without further ado, let me get into the euro. We'll start with the forex market, we'll move into commodities, then the indices, and a bit of crypto. So this chart is fairly unchanged from last week, and I think it's quite instructive. We had a potential inverse head and shoulders pattern going on here, where you can obviously see left shoulder, head, right shoulder. The pattern completed. We had a big move higher, and then just shy of 2250, we sold right back down to the neckline again, and then we saw some heavy selling in through Friday that took us below 121. As of Monday, we came up for a test on 121 and have started dropping again. So this is something I comment on a lot. A comment that I make a lot is that you can trade a price pattern, and obviously if the pattern completes and works in your favor and you have a profitable trade, that's fantastic. But if the pattern fails, then oftentimes that can lead to a loss or even a break-even trade, which is not so good in itself. But what is good, the silver lining, is that the failure of that pattern can often be a very good signal in the opposite direction. So if you're adept to following the market and you're following your, you're keeping up with these assets and you're watching the trends and you have a certain trade in mind and it doesn't do it, that in itself is a strong signal. So that's how I'm looking at this failed inverse head and shoulders pattern. I'm thinking actually this is quite bearish. And so while before this failed pattern, I would have imagined just a drop down to 1950 as a kind of base case scenario for retesting this low. Actually think maybe we can go lower now. And so if that is the case, maybe it's not much lower, maybe it's down to through lows down here, through maybe 1850. Or indeed maybe we drop right the way down to 116 again. I did highlight those kind of bearish possibilities before, and I think they are still alive. Right now we're at 120.50. I think 120 really is the line in the sand, as we mentioned in the week ahead video a couple of weeks ago. If we get that drop through 120 brought about by these surging bond yields, then we could be on for a steeper fall. So this failed pattern for the moment bearish. Some pretty a couple of one in particular fairly bearish looking day, and it does sort of imply that this correction has a bit further to go, maybe just down to 1850, a re-challenge of these peaks down here, or perhaps a little bit further. So in terms of setups, we're down at 120.50. We've already come away from 121, so often you get that early move in the wrong direction before the actual bigger trend resumes itself. So that being the case, we're finding some support off 120.50. If you can get a little bit of a lift off 120.50 as support, then maybe you can rejoin the trend. Otherwise, if you're looking for higher prices, then really, we've already been up through 122. Probably we don't get to 122 again if this down move is going to really materialize, but we could get a retest of the neckline again. and that would be up around 121.50. So 121 has acted as a barrier so far. We're sitting at 120.50. If you really want to hold on for a kind of better risk reward, if you want to hold on for the real premium trade, in 21.50, but it seems to me quite likely that we don't get there. Moving swiftly on to the pound, this is very interesting. So obviously the pound has been as we noted in the week ahead video this week, the pound has been the top FX performer among all the G10 currencies this week. But look at this weekly reversal pattern. That is a very bearish looking candlestick. I'm just talking about this last candlestick here. You know, a decent run up obviously, but that's a strong reversal. So what, sort of 300 pip. We've got to highs above 120 or 142, and we closed at 139. So you're pretty much a 300 pip weekly reversal. Yeah, that is bearish. Always, you know, the best bearish patterns happen in a strong uptrend, so that's kind of nature of the beast. To me, this implies some more downside here. The question being, if you are going to try and play this weekly candlestick, a bit like the euro situation, we've already had the early bounce up to 140. That might be all we get after these 2 heavy days of selling. There's probably not too many enthusiastic buyers, dip buyers out there. If you really want to cling on to the kind of pristine setup, then you can kind of ride it all the way up to 141 again, and make the assumption that this top will hold. But again, it's sort of feels to me less likely that we even get there. If we do continue down, a test of these previous highs through here, which is about 137.50, that would probably see us hold 137.50 through 137, which you can see I've drawn on the chart here. That little zone there would enable us to hold on to this rising trend line, or just a small break of the trend line would see a drop down to 136 and this low through here. And I think given the extent of that weekly reversal, I suspect this modest break of the trend line is a bit more likely. So given that we're up at 140, well, we're below 140 now, we're at 139.50 really. But potentially, if we do drop to 136, then we've still got 350 pips of downside here, and then it's a matter of, again, it's always risk reward. If you're playing this as the top, then ideally your stop loss is above the high, but obviously that risk reward is less attractive from current levels. So that's the reason to wait for a bounce, is for better risk rewards. Or in terms of tactics, you lower your stop loss, but there's a greater chance of it getting hit, but the trade's still working. Okay, let's move on to dollar yen. So this is another example of a chart that I've just not, I did add a Fibonacci to be fair, but otherwise I've not changed this chart because it's working pretty much as we said. Break of the high, break higher, test that high, pull back, test the previous high, rally up, test that high, pulls back to the 105 round number, rallies up, takes out this high, looks like it's heading to these highs through here, which comes in at the 107 level. And I thought I would note actually that these levels are pretty much perfectly correlating with the Fibos. So 38.2 is where we've just broken, we're approaching the 50, which is these highs through here, and then we've got the 61.8, which is this peak up here where this trend line began. So a complete reversal of the channel would take us up to 108 and the 61.8 Fibonacci, which seems like a good probability at this stage. So really, really trading with this trend. We're obviously at the highs at the moment, but if you're short-term trading, it looks like we're heading towards the test of the 50, these highs, and the 107 level. There's a confluence of resistance up there. You could sell into that resistance, but that would be counter the current momentum, but it would be in keeping with this kind of broader sweep from left to right. So that could be a decent opportunity. I think you'd probably want to see some confirmation with a daily reversal candlestick at 107 in this confluence area. That would be interesting. Okay, moving on to the oil market, and you see that I've just put in a little highlight here because this is quite an unusual pattern. You don't see these this often. This is an evening star doji pattern, where you've got the evening star pattern, which is the kind of bullish pattern, the typically a kind of long wick sort of reverse pin bar looking reversal, and then the next down day. This time it's not a long wick, but it's just a doji where there just wasn't much price action in there at all, and then the day down. So this is quite bearish, and it does come in at this long-term area of resistance. Okay, arguably 65 is more like the kind of important level, but often these these reversals, everyone's watching 65, so the kind of the trader's logic, right, is if you think the price is going to reverse from 65, you don't wait for 65, you sell it at depending on your time horizons, you sell it at 64, you even you sell it at 64 and a half, or you sell it at 62. I mean, depending on how much you're willing to risk versus how much you expect it to drop from there. But it makes sense to me that the market it stuttered first with this weekly reversal at 62, but then we had another positive week after, but now we did come off the highs of that week, and just it's interesting, this daily pattern, we're not too far off the highs, so the risk reward from a short sale is quite good given how far we've rallied up, and we're not really far off the highs. Obviously the major disadvantage if you're trying to short this market is that you're just going completely counter trend, but as I always say, as long as you've got some logic, you're not just selling because it's up, it's gone up a lot, probably it needs to go down now. That's not a solid investment idea. But if you do have a unusual reversal pattern in combination with a long-term area of resistance, that's a couple of good reasons for a trade. Of course, it may not work out, but there is some powerful logic there. That's a proven investment strategy over time. A lot of this always comes down to how much you make of the opportunity. I would say if you are kind of taking these counter trend trades, you need to get the balance right, where you got to be aware that you are going counter trend, so the move may not go as far, but also you have got to make sure you don't take profits too early, because oftentimes these counter trend trades won't work, so you need to cut out kind of quick, and you need to kind of maximize it when you actually have picked a top. In essence, you need to really try and ride that wave down. Okay, moving swiftly on to the gold market, and so we've still got our channel in play. I've extended the lower channel line because I feel like this does sort of make sense for where we are now. We've taken out the 50% Fibo level. It was looking good for a couple of days. We had a bit of a rally up. We held above 1800, and then we just stalled above 1800, and we've crashed lower. And actually, technically, pretty solid actually. From if you're looking for short trades, right? We pretty much just banged straight into that way. We had our support there through all these lows, rallied up, banged into it, and just crashed lower. So actually, if you had been eyeing up that previous major support there, the fact that we dropped through it, we retested it, and then dropped through again, and kind of at the moment we're basically retesting this previous support. We're bouncing up. So if you're thinking in terms of the dollar, we're getting a bit of a bounce in the euro, a bit of a bounce in the pound, bit of a bounce in gold. They're all testing these former. In the case of gold, it was already downtrending, so it's testing lows. In the case of the pound and the euro, slightly different situation. The chart looks different, but you can see that we're either about to see another bout of dollar strength, or we do pop back through these levels and normalize a bit here. So watch out for this 50% Fibonacci level. Pretty much 1760 is the big one in gold. It's resistance for now, and if it holds, I do think we probably tend towards these lows through here in the 61.8 Fibo. And even if we get a bit of an extension through there, we to retest this lower channel line again, then it's going to be even lower. Moving on to silver, I mean, this is interesting. So if you remember last week, what I was basically saying is that this level has held, and we rallied up and we got through the resistance again. But obviously it was a big move in treasury yields, gold tanked, and it's a little bit difficult for silver to do well in an environment where gold is tanking and yields are moving high, because obviously you don't earn a yield on silver, you don't earn any interest from your silver trade, it's just a lump of metal. But having said that, I think it's held up pretty well. And remember, we're still, what's interesting about silver is we're still in the aftermath of this huge short squeeze, attempted short squeeze, that pushed the price up higher here. Now a bunch of institutional sellers came in, I think, and pushed the price back down again with silver futures, which we're not going to knock, because our CFDs are based on silver futures. And a derivative of those using spot prices. But what am I saying here? That the price has come down when that short squeeze initially failed, but the fundamentals behind the trade are not bad, as in there's not much physical silver around. It's very difficult to get some physical silver. It's all been bought up in this attempted squeeze, and so that's going to have some impact on the market. There's going to be limited desire to really sell silver down when actually the real physical supply of metal is so sparse. So anyway, we're holding this level. I think we probably do take this level out if gold continues lower, but maybe we just get down to 24, which is these lows through here, and maybe that can tee us up for another go. I mean, it's a tricky chart. It's pretty choppy. I think just it's one of those, we try and pick the levels. At the moment we're picking this level, and we're going for a move up to the highs. If this level gives way, we quite easily know when we're wrong, and then we're looking to the next level, and just remaining fairly optimistic. And I think it's only when we take out 22 that we can start thinking, well, we're out of the range now. It's a different scenario, probably not so bullish, probably going to follow gold lower. Moving on to indices, I mean, this was really interesting. This head and shoulders pattern in effect worked twice since we first noted it. You dropped through the level and it worked once, and then we rallied straight up to the neckline. But depending on if you had a fairly secure, if you had your stops above the head, you'd be absolutely fine. If you had a decent distance above the left shoulder with a bit of margin for error, then it worked a second time, but by even more, because it just basically formed a third shoulder and tanked. But it looks like 3800 is holding for now. I think probably the next area of interest will just be the neckline again. Let's see if there's another reversal at the neckline and we could trade it back down to 3800 again and see if it actually finally breaks that time. And so if it does, I think after two tests it won't be very difficult to get down to 3700, or maybe even a test of these lows down here, depending on depending on the levels that you entered at. Potentially another good risk reward drop. It's still a pretty bullish market overall, so this may be the extent of the kind of, particularly if bond yields keep trending lower as they did on Friday, then probably this is the dip to buy into for the next before the next record high. If you look at that, I mean, this is not really a market you want to get particularly bearish on, is it? I mean, this looks pretty bullish. It just looks, this little dip that we've had, while it felt pretty panicky last week at some stage, it looks a bit like we've been doing for a while. So it could turn into one of these, which would be a bit more interesting, and that would be the test of these lows down here if it was kind of more of one of these larger dips. At the moment it's just been kind of a repeat of this, what we saw in what was that, mid-January, had a bit of a sell-off and then rallied straight up. Looks like another one of those. So I think probably the what's the summary here is probably buy the dip, but just look to that neckline level that I mentioned there on the H4 chart, just to see if anything interesting happens up here for another sell-off. Finally, last but not least, Bitcoin. You could pretty much say the same about Bitcoin as you could about the S&P, where and silver to some extent, where it came in for a really heavy week. It came down to a 20-day low, I believe. So it's obviously challenging this support back through here. You know, I've got it in the low, but you can sort of see it's like testing the close sort of thing. It's basically successfully tested this low through here twice, you could say, and there was a bit of kind of rising trend line through here, which it seems to have held on to. So I think, you know, maybe you could even just, because we're quite far off the highs, so even if we get a breakout through this high, you could start to think that actually it looks like it's done its correction A, B, C, and we're ready to take off again. So I'd say it looks fairly positive in Bitcoin. 50,000, obviously the big one. We're below 50k, and so you probably want to be a bit cautious below 50k. But I think if you take out this peak, you know, you could get a bit optimistic going in for another break of 50,000. If you think we've got further to go, I mean, there is some logic to that, because we have seen a pretty steep sell-off. If you look at this daily chart, sort of equivalent to the last one we had, again mid-Jan. But you could look to either this high down here would just be like a little bit further to go in terms of a position to buy the dip. I think if we do take out these lows, it probably goes a lot further than here. But it could, you know, we had this spike high down here, which was you can see better as a kind of area of resistance. That could be interesting down at 38,400. If we get another sell-off period, that, you know, that could be the one. But with a few big boys, we're talking about buying last week. Square added to its position. Kathy Wood of ARK Invest was very positive about Bitcoin. So there was quite a few positive comments coming out. So let's see. I mean, at the moment, I would say while it's holding this rising trend line, will look good. Look for this taking out this high as a potential upside trigger. If we get another dip, look to these lows down, these former highs down here as a potential new support. Right, great. Thank you very much for watching, everyone. Good luck trading this week, and make sure to subscribe to the channel so you don't miss these videos as soon as they come out. Thanks, everyone.